Acquisitions. I want to talk about an idea called agglomeration. And agglomeration is really a hack of the traditional roll-up model. My business partner is a guy called Jeremy Harbour. He's considered one of the thought leaders in small business mergers and acquisitions. And this idea evolved primarily because both of us had tried to sell numerous businesses. And it may surprise you to know the market never valued our businesses quite as highly as we did. What I think, there's a lot of talk about innovation in startup and in financing of small businesses. There's not much talk about innovation at the other end, and this is really innovation at the other end. And I think what the implications are actually going to be very huge for small businesses, and I think because they're so huge for small businesses, that's going to have an impact on bigger businesses as well. There is a hysteria around startups at the moment. I know you've got a bit of it in New Zealand. In fact, every single country in the world is trying to position themselves as the next Silicon Valley. The governments are chucking tons and tons of money into it. Everyone's proudly running around calling themselves startups. I used to be invited to speak at a lot of startup events, and then I wrote an article that said, stop calling yourself startups. The hardest thing in business is to have credibility. The minute you define yourself as a startup, you lose all credibility. Yet this weird little ecosystem has grown up around Silicon Valley, and so everyone's proudly calling themselves startups. I don't get invited to startup events anymore. But the interesting thing is you've got all this focus on, and it's basically gambling on lots and lots of startups in the hopes that you're going to get a unicorn, which in many cases is just a horse with a pointy valuation stuck on it. But actually, if you can find good small businesses that are doing $1 million in revenue, they've already found a problem. They're already solving that problem. They've already got good staff and they've got good customers. If you can help that business go from 1 million to 10 million, you're pretty much guaranteeing 20 to 30 new jobs. There's much more value for the society in terms of doing that than there is in often betting on these startups. That's why I don't get invited anymore. The other thing that I think is worth exploring is this entrepreneur delusion. A lot of people are jumping out of really good jobs to join these startups, to become entrepreneurs, and they have this idea that in 3 years' time they're going to sell their business for millions. I call this the entrepreneur delusion because the data just doesn't support it. In the US last year, there were 26,000 small businesses sold. The average price for those businesses was $260,000. It's really depressing. Right? And those are the businesses that are good enough that actually get to a point where they can sell, and they sell for $260,000. You then split that between however many partners are in the company. You're not retiring on that. So there is a bit of a delusion around the entrepreneur dream. Fundamentally, there are kind of 3 reasons why small businesses get such poor valuations, and this was the problem that myself and Jeremy were trying to figure out. So the first one is risk. Small businesses are inherently risky. Even the best ones are typically only 2 clients or 2 key staff members are leaving from having their worst year ever. Investors will factor that in, so the prices are low. Not many opportunities to get a slide of animals mating into a presentation, but my first business partner always used to say to me, elephants only mate with elephants. I could probably find a more appropriate picture, but anyway. Small businesses face what we call a scale paradox. As a small business, under-resourced, you can't go for those big contracts. Because you can't win those big contracts, you remain a small business. In fact, oftentimes what happens is another big business will win that contract and then outsource the work to you while creaming off most of the profits. So small businesses get stuck in this scale paradox. And the final one is liquidity. If you have ever invested in a mate's business, as unfortunately done a few times, you'll know it's nearly impossible to get that money out. Small businesses are incredibly illiquid. And so consequently, investors will punish those businesses in terms of the valuation, which is why myself and Jeremy were getting lower valuations. We knew that we had good companies, we knew we had great staff, great customers, but because of these three factors, we were getting low valuations. Then you've got the other things like demographic. There are less people out there to buy the business than there used to be. In fact, this demographic cliff, there's 12 million businesses in the US right now, and the US has just got better data, but extrapolate out for most Western countries. There's 12 million businesses, 8 million businesses in the US are owned by baby boomers. Baby boomers are retiring at a rate of 10,000 a day. So there's an estimated 8 million businesses are going to come on the market over the next 5 to 10 years. If the average price right now is $260,000 and you flood the market with millions of new businesses for sale, what's that going to do to the price? The other problem you have is that nobody's buying businesses anymore because it's much cooler to start up a startup, and it costs nothing. You can start up a startup as a side business. You can have global reach and all of these other cool things for $100. Why would you invest a ton of money in an existing business? That now seems risky. So valuations of businesses are going to plummet. So we came up with a model called the agglomeration, just because it's difficult to pronounce. The agglomeration, in effect, is a collaboration of entrepreneurs to IPO. It's a collaborative IPO. What happens is you bring together, say, 20 businesses from the same industry, geographically diverse. You take that group of companies and you list that company. What that does is, from an investor standpoint, you minimize risk because you're now investing in a portfolio of small businesses. For the companies themselves, they get over this scale paradox because when they want to be a small, unique company, they can be a small boutique company, but they can also point to the balance sheet of the whole group. So when they want to be a big company, they can be a big company. They can now bid for those bigger contracts and cut out the guys in the middle. They also have sister companies around the world. A lot of small businesses try and raise money to go and expand into new countries. It's a very, very expensive way of doing it. You typically make a lot of mistakes. The first year is very painful. If you have a sister company in a different country with a vested interest in your business, it's much, much easier to expand. And the third one is because you're an IPO, you're now in a full liquid environment. For a business owner, that's very exciting. That means that rather than selling your business being a binary event, you can now sell a little bit of your business and buy a house. You can attract senior staff to work with you. Most senior staff are pretty skeptical about earning private stock, but public stock that they can see their value go up and down, they can trade it, is very different. So you can suddenly start to do a lot of things with the liquidity that brings you. Finally, you can use it for acquisitions. You basically have a new currency which you can use to expand. Being that we're sort of now in a mergers and acquisitions space, our answer to everything is acquisitions. If you want to move into a new country, acquire somebody. If you want new staff, acquire somebody that's got those staff. It's a bit of a one-answer-fits-all solution. The reason why this is slightly different from the traditional roll-up model is what we've discovered is that the traditional M&A space, the traditional roll-up model is very ego-driven. It's very much, I'll buy your company because I love your company, and then I'm going to insist on putting my logo over the door and imposing my best practices on you. At which point, you, the founder, leave, take your best staff with you, and I've just destroyed half of the value that I was buying in the first place. This is about a collaborative IPO. In effect, what we do is we bring the CEOs, the founders together. They're part of this group. They're now owners of this group, but they've got no say over anybody else's business. They've still got full control over their own business. We obviously come from an entrepreneurial background. As entrepreneurs, we were never particularly good at taking top-down management. So we assume that the entrepreneurs that we work with will equally have problems with that. So we leave them in full control of their business. It's their brand, it's their hiring decision, it's their budgets. But you have them in this group. Once a quarter, they come together to talk about the stock price. They can't talk about how anyone else is running their business. They've got no say over that. So that's where they start to look at the synergies. Most people, when they do M&A, they obsess about synergies. We don't obsess about synergies. The value increase comes from being part of this group. You can double or triple the value of your business overnight by joining one of these agglomerations. This is an example of one. Unfortunately, I had to remove the numbers from the big bubbles because we're currently in the quiet period. This is a group of marketing companies that we are listing later this month. We're listing them in Europe, but we've got companies in the UK, Singapore. I'm actually meeting with a company here in Auckland tomorrow that's joining this. In effect, what happens is we list with a small number of companies, and then we reverse in a next group of companies, and then we reverse in a next group of companies. So by the end of this year, we will have around 20 to 30 marketing, digital, video production companies around the world in this group. Without mentioning numbers, we'll be about the same size as an M&C Saatchi, but we'll have achieved it in 12 months rather than 28 years as they have. If you were doing traditional M&A, you would get massive, massive indigestion from doing that as you try and merge the cultures and the systems and all of that sort of stuff. Since we don't need to do that, actually, you've got a very, very scalable model. The companies, of course, will start to collaborate with each other, but the model's not predicated on that. Even if every company remained completely siloed, didn't talk to each other, you would still get that massive uplift in value. It basically unlocks the value that's already within those businesses. Why are we doing this? So I mentioned that we were trying to solve a particular problem, but it's unlocked a kind of a bigger idea. When we spoke to a lot of investment banks, a lot of private equity, and one of the things that we kept coming back to was there's a general belief that you need to keep entrepreneurs poor. Entrepreneurs basically get shafted at every level. It's the entrepreneur that mortgages their house to pay wages. It's the entrepreneur that is the last person to get paid on an earn-out. And the belief is that entrepreneurs need to be kept poor, to be kept hungry, to work hard. We actually have a very different idea about entrepreneurs. We believe that entrepreneurs are fundamentally problem solvers. And if you can give them resources, if you can give them liquidity, then actually what will happen is that they start solving bigger and bigger problems. Ultimately, what we believe is that once you've solved enough problems in your business or in your industry, you start playing a bigger game. And if you look at philanthropy right now, what you discover is most of the interesting stuff that's happening in philanthropy is being driven by entrepreneurs. Not by charities, not by NGOs, but by entrepreneurs that are going out there and making change. And it's not just the old fellas. Zuckerberg this week announced that he wanted to change the structure of Facebook so that he can sell all of his shares yet retain control. That's because he wants to give 99% of his wealth away in a way that helps humanity without keeping control of it. Sean Parker last month announced that he's donated $250 million to creating an IP-free platform for cancer researchers to share their research from around the world, and he's protecting that. One of the scientists involved says that he reckons that's forwarded cancer research 100 years by providing that platform. So we believe that if we can help entrepreneurs to get more liquidity and grow, they're going to solve bigger problems. So I think that's quite an innovative approach for collaboration, not competition. It does, one of the things that often comes up with entrepreneurs that we speak to about this is, yeah, love the model, get it, love to triple my value overnight, that's brilliant, but I've got one competitor and I hate them. So I'll work with every other company, but just don't bring this one competitor into the group. The way we run it is through a constitution, so everyone gets a vote on the board. And we said, well, it's just going to go to the board. Like, does the board will this add value to the stock price? And actually what you find, it normally takes a couple of drinks, but what you discover is that when you think about this with a collaborative mindset and not a competitive mindset, you realize that actually you'd much rather have your competitor in the group. Because if you two both go and bid for the same project and your competitor wins, your share price still goes up. You don't actually have to do the work, which is quite a nice place to be. Also, wouldn't you rather have them in the group than outside the group? So suddenly there's this incentive to start thinking much, much bigger, which allows everyone to grow faster.